and welcome. I'm Ekta Batra and I'm at the Standard Chartered South Asia Credit Markets Conference 2015, a forum where we will see lenders as well as investors join in to discuss global as well as domestic cues. The second edition of the Standard Chartered South Asia Credit Market Conference 2015 was inaugurated by Mr. Ajay Kanwal, the Regional CEO, Standard Chartered Bank, followed by a keynote address from Mr. Y.M. Diusthaly, Chairman and Managing Director of Larsen & Toubro. The rest of the conference included personal issuer-investor meetings and riveting panel discussions and talks with industry movers and shakers.
A warm welcome to everyone. This is our second conference. We did one last year too. And we were very encouraged by last year's participation, which is why we decided that we'll do this annually. What's very unique about this conference is this is the only onshore conference focused on fixed income. And we do our best to bring both investors as well as issuers together. And these are international investors, local investors, as well as local issuers. So great time for people to get together, understand what's happening, and also exchange views not just on India but also on South Asia. I think this year is very interesting, probably more interesting than last year I feel, because last year we had a huge headwind on the new government coming in, the Achhe Din promise, which is India is going to be great very soon, but there is obviously some amount of softness in what we think will happen. So I'm sure you all will discuss both aspects, the macroeconomic piece and what's happening around in South Asia and the rest of the world. Have a good day and thank you so much.
Thank you very much, Standard Chartered Bank, for inviting me. These are very interesting times in India. And as the saying goes, may you live in interesting times. India so far has never been so interlinked with the global economy, and the global economy has rarely been so volatile. This is also a time of hope, great hope and optimism for India. With a political leadership that is focused on economic growth, by all accounts, we are in interesting times. The Indian economy is undergoing a process of gradual recovery. Fortunately for India, the macroeconomic situation looks very promising. The GDP growth has picked up and stood at 7% for the previous quarter. Foreign direct investment for the year 2014-15 rose handsomely by 54% from the previous year to 24.7 billion, indicating rising investor confidence in India. Fiscal deficit for the last year was 3.99%, within the 4.1% target for the year. In the recent past, we have seen the index of industrial production growing at 4.2%, which was abysmally low prior to that. So there are some signs of recovery on the industrial front also. Recent data suggest that project execution has started slowly picking up, and the backlog may be cleared sooner than expected. Out of the 680 large stalled projects with an estimated total project cost of $450 billion, this government inherited, issues relating to 307 of these projects have been completely resolved. While short and medium term outlook suggests a recovery for the Indian economy, and the financial services sector will also hopefully recover along with the economy, some other structural issues with the economy also pose a long-term challenge for India's growth. We need agro industries to develop, and we also need other industries to develop in cities and towns. The government has embarked on ambitious programs of the following three fronts. First is Make in India initiative. Skill India is another initiative for imparting employable skills to people migrating into manufacturing, and finally Smart Cities initiative. For India to graduate to middle income and then to high income status, it is necessary that these three programs of the government are sustained and implemented aggressively. I am reasonably confident that despite internal and external challenges, it is a great time to invest and stay invested in India. If the economy gathers momentum, as we hope it would, the second chapter of the India growth story will be even better than the first chapter that began in 1991. So, interesting times are certainly ahead of us. Thank you very much.
Well, time for a break now, but up on the other side, we'll get discussing on infrastructure financing and get some industry views.
This is the second year of the conference. When we held it last year, we got real strong encouragement from all participants. Essentially, this is getting together in international investors and not just investors in bonds, but also in loans, along with the issuers. And it's very unique in a sense that this is the only conference focused on debt. If you take this year, about 40 participants, both international investors and loan investors, along with 27 issuers. So people coming together and discussing best options for debt, not just in India, but in South Asia. So from that perspective, it's very unique and very timely too. I mean, if you look at India, clearly a great opportunity for growth, infrastructure being an example, and of course, a lot of development in building up Make in India opportunity. And so from that perspective, I think very timely and a great time to have this conference.
Welcome back. You're still tuned into the Standard Chartered South Asia Credit Markets Conference 2015, now focusing on an infra panel to talk about infrastructure financing. We have 4 panelists joining in. Mr. Sameer Asta, Director Finance and CFO of CLP India Private Limited. We have Mr. Drupad Upadhyay of Island FS Transport Network Limited. He's the Vice President and Head of Investor Relations there. Mr. R. Govindan, the Vice President Corporate Finance and Risk Management at Larsen & Toubro, and Mr. Anurag Srivastav, Chief Financial Officer of Tata Teleservices Limited. Mr. Govindan, I want to start with you. First, can you start by giving us a background in terms of where infrastructure is right now?
Over a period of time, what has happened is the competitiveness in the sector has led to a lot of challenges. The power in the entire sector has moved to the government. The government decides the terms under which the public-private partnerships are done, and the whole game is shifted in a different fashion. If you look at it, if you have to summarize, the weakest link in the infrastructure chain is the owner of the infrastructure. Next probably is the bank who has lent money there. There are a lot of legacy issues which have been there for the existing whatever projects people have held on. A lot of half-done projects. This is the backdrop in which the new government came in. There are a lot of positive changes that happened in selected sectors like power. So things are evolving. It is definitely getting better. But to assume that everything will happen overnight, that was not a reasonable expectation.
Mr. Srivastav, your sense in terms of whether there has been any formidable improvement within the infra space, say in the past 12 to 18 months?
One distinctly positive thing which has happened is there's a lot more transparency on auctions, etc. But on the other side, some of the other regulatory stuff, which is things like stacks. I think if we can expect more on the speed of these things, that will be welcome. But definitely a clearer, transparent management of this thing.
Mr. Asta, you work in the renewable energy space, something which is more of a sunrise sector for the new government. A lot of impetus towards that as well. But how has it been different for you, maybe in the past few months?
Well, when we started, CLP started in India, we started with a gas-fired asset. And today we see there's practically no gas in the country. So, however, on the renewable side, it's been relatively easy because there's no fuel required. So you eliminate one of the risks which we perceive as one of the biggest risks for the power sector. On the renewable side, we today have 1,000 megawatts of wind, and we've had to go through a long process to reach there. And there the key challenges which we face is how do we reduce our interest costs.
Okay. Understood, madam.
We've seen some efforts on the government to restructure and change the model concession agreement, work around the CPs of land acquisition, environment clearance, etc., making them mandatory before the NHAI actually comes out for a bid. That's one. Secondly, to also address the lenders issue. Another critical issue was that lenders have stopped lending or have become very conservative. Award activity is taking place but not at the intended place.
Can you tell us what, Mr. Govindan, is your primary source of funding, your most comfortable source of funding rather, and what sort of blend do you have for most of your projects right now?
As the developer of these projects, actually any money is welcome. Frankly, I don't think the companies have a choice of this is good, that is not good. Any money is welcome. So it will be 30% equity, right? 1% will be between international debt and bond market. 69% would be bank debt.
A bank loan gives a more relaxed or more sort of changeable covenant scenario. So you can always probably go back and relook at the covenants. Unfortunately, the bonds, etc., does not give that sort of a flexibility.
So what is important is that you need to get, whether you go to the banks, you go to the ECB market, or you go to the bond markets, you must have a very good project on the ground. Once you have a good project on the ground, it will be very easy to raise money from whatever sources available.
Mr. Govindan, what is CapEx looking for you right now?
I think the intensity or the intention for the private groups or private companies to go on an investment program is very weak. So if the government, I think, is also looking at creating a good bank, bad bank, remove the NPAs, that will clearly segregate the issues completely, and then people will be able to look at things slightly more positively and then move on. This is really what is happening.
We've been waiting for that good bank, bad bank, maybe some sort of guidelines at least to come out for it. But thank you, gentlemen, for joining in and taking us through this discussion. Well, time for a break now, but once we're back, we're going to look at trends in the capital markets.
These conferences are extremely useful. Both equity and debt investors, they should get what is the correct perspective of India is concerned. So we need to visit their countries and also explain what's going on in India, and also we must invite them time to time to make sure that they have a realistic picture of what's happening. And since the globalization process started, investors are all looking at India since around 99 onwards, 95, 99 onwards. But over the years, they've also realized this is one country where governance standards are improving. This is one country where the legal system is reasonably good. There is one country where information is available, and therefore you don't have to short guess as to what's happening in the country. So this has to continue. We have to work on this path and make sure that they understand that Indian democracy is a democracy for us to invest for a long period of time.
The idea of this particular conference, and it's a repeat of what we did the last year, was to bring together issuers and investors and have a free and flowing exchange of ideas from very different perspectives. So we've managed to put together, as you know, about 40 investors, 27 issuers. We have more than 350 meetings arranged between issuers and investors over the last 3 days. And this is across loans and bonds, this is across local currency and foreign currency.
Welcome back. You're still tuned into the Standard Chartered South Asia Credit Markets Conference 2015. I'm now in conversation with Henrik Weber, the head of Global Capital Markets at Stancy. Well, starting with the global market space, we've seen a lot of global turmoil, you'd have to say, taking place. For example, China and the slowdown in growth, the Fed not hiking rates as expected, possibly an indication of what's happening with growth, as well as commodity prices slumping. In that context, how exactly are the trends of the capital markets globally as of now?
Well, particularly post the Fed decision, the capital markets have had a relatively challenging time. The bond markets have seen credit spreads widen, particularly for some of the commodity-related names. But we think this is a short-term impact, and the emerging markets will stable looking forward. The longer-term effect of lower commodity prices is also similar to a tax cut. So as we look forward 1 or 2 years, we think the growth cycles will start to return to the emerging markets. And we'll probably see some funds flow back into particularly the Indian capital markets or the ASEAN capital market. As we've seen during other sort of turmoils, investors tend to move to safer assets. That could be bonds with higher ratings or companies with perceived less credit risk. So that's one of the effects we're seeing today. We're also seeing an increased move back to US dollars out of some of the local currencies, as some of the local currencies have been weakening. And that weakness really started around the summer, but has accelerated post the Fed not moving last week.
In terms of the commodity companies, what are the trends that you're seeing with regards to commodity companies? Are lenders now becoming a little more cautious in terms of lending?
Well, I think within the commodity complex, certain specific assets which are under pressure. Oil and gas has been one area, metals and mining. But on the other hand, the agriculture sector continues to be very strong. So not surprisingly, capital is moving towards some of the stronger sectors as the markets go through some turmoil. But we think this will rectify itself, and the long-term growth trends, particularly around emerging markets, remain very positive.
What are the trends that you're spotting in India?
In India, we've seen a lot of enthusiasm over the last 2 or 3 years for international investors to invest in the local markets. We've seen continued inflow of funds. We expect that's going to continue. On the US dollar side, we've seen a very active issuance of the high yield bond markets. And we've even seen some green bonds come out of some of the preeminent issuers in India. We think this is a trend that will continue as companies increasingly move away from loan financing to bond financing. Well, we think that the financial institution sector is going to be very active. Obviously, the banks have a continuous need for sort of regular funding. Moreover, there's an expectation at some point we'll start to see the capital transactions appear as some of the banks start to increase their balance sheets in terms of capital, and some of the AT1 transactions have been talked about for some period of time.
Okay, and lastly, for India in specific, what is the interest as compared to other emerging markets, the likes of Indonesia, the likes of Malaysia, Brazil even?
I think India currently has a relatively unique position within the EM space and capital markets. The markets are a lot more stable. The investor demand or appetite to invest in India, given the long-term growth story, is a lot stronger than some of the ASEAN countries, which are facing, for example, more deep political problems or structural problems. So the enthusiasm around India is very strong. We expect that some of the implementation from the government will start to appear over the coming 12 to 18 months, and that's going to continue to drive investor flows. But arguably right now, India is a little bit of a safe haven in the emerging markets turmoil that we're seeing.
All right, thanks Reba for joining in and taking us through your thoughts. Well, the second edition of the Standard Chartered South Asia Credits Market Conference 2015 was once again a great success. The Bonds and Syndicated Loan Convention provided a unique and exclusive forum to bring together domestic and foreign investors and lenders keen to leverage upon the economic changes in India and share views on the South Asian credit space from a global and local perspective.
I think there was general optimism in today's session, and I just hope that the execution on the part of the government continues to be the way that all of us would expect it to be. I think it's very important for the foreign investors in particular. I mean, over the last 3 years, they have been slighted by various issues in India, whether it is on the infrastructure side, whether it is on the tax side, whether it is in terms of what they have called inability to enforce contracts and so on and so forth. So I think forums like these are great because it sort of one tells them as to what's really changed in India over the last 18 months or so, and when people who matter actually talk about their expectation, the fact that things seem to be on the right track, I think the foreign investors in particular get encouraged to do more in the country.
The day's been excellent. This is my second time, and I think it's a great show of Standard Chartered's depth of relationship in the market. They're one of our biggest partners. And I think the highlight for me really was the one-on-one meetings and the level and the quality of people that come to the one-on-one meetings. I think the panels this year also were excellent, very high-level panels on infrastructure. Once again, I mean, it really does show that Standard Chartered is one of the highest-ranking banks, and in this type of a market where there's not a lot going on, a lot of refinancing going on, and a lot of liquidity in the market, but to be able to demand the great relationships and to have people come that can really speak to the trends that everyone wants to hear about, it really shows the quality of the bank.
Well, with that, it's a wrap on the show. Thanks for watching from the entire team.
Focus, ideate, innovate, enable.